discussing our new essay, We Need Genuine Short Sellers, Not Imposters. The essay is about two things. One is the problem with current short sellers, which in our opinion are imposters, pseudo short sellers, pseudo investors. They don't have skin in the game. They're entertainers, merchants of doom, people like Jim Chanos, Einhorn, also the newsletter Doomberg. We put them in the same category. The majority of people in the market who are spreading negativity, and some of them claim to be shorts, are in fact not what we would consider a genuine short, simply because they don't have skin in the game. At best, they buy puts. Most of the time, probably they don't even have a position, or if they have one, it's so small that it's not tangible. If you don't have real risk in the market to lose real money, you're not an investor. You're something else. So this is the first thing. But the second thing that we're arguing for here is actually that first, I mean, there would be a great benefit actually to have genuine short sellers. Short sellers are very important for the market for several reasons. One is they provide liquidity, but more importantly, they also put the innate optimism of investors in check. By the way, we're talking here specifically about shorting innovation. So we're not talking about forensic shorts, fraud, any of that stuff. We're talking about the people who are, for one reason or another, generally trying to spread doubt about innovation. And the other thing that we want to mention, or we're mentioning, in the essay is we're saying that buying innovation and shorting innovation are two sides of the same coin. They speak each other's language. It's the same thing. If you want to be a successful short seller, shorting innovation, you can do that. It's actually possible because the analysis is the same. This is the key insight in this essay. And the best short sellers are actually those who are the best buyers of innovation. This is not In Wrong Podcast. It's February 4th, 2023. This is Krim Delko. It's a Saturday. There's no update. For the year, we're up 58.3%. The market is up 7.6%. We're out from by 50.7%. We are discussing our just published essay, We Need Genuine Short Sellers, Not Imposters. In this essay, we argue two fundamental arguments here. One is that the short sellers in the market, the self-proclaimed short sellers, most of them are not real short sellers. In fact, they are at best just gamblers, and they're really merchants of doom. They have, for some reason, an axe to grind with innovation. We're focusing here on innovation. So when we talk about short sellers here in this essay and in this particular episode, we're talking about people that are short innovation. So Jim Chanos would be, he's the tip of the iceberg. I don't want to just rattle around him, but he's a good example because he takes pride in going on TV and in other media and continuously touting negativity about innovation. People like even Hugh Henry, I would count him into that. So a lot of these so-called hedge fund managers, most of them retired, or like Jim Chanos, from my point of view, he's just a glorified journalist at this point. I don't believe he has a position, because if he had a real short position in stocks like Tesla, he'd be out of business by now. So clearly, maybe what they're doing is just buy puts. And this is one of the arguments that we're actually making here is if you buy puts, then you're not short, then you're long puts. And that's a whole different position, a whole different ballgame. But let's get back to the main points. Again, I'm saying that that we need genuine shorts, and most of the shorts in the market are not. That's a problem, because we would love to have real shorts in the market. It would be great. And in fact, the other argument we're making is that the best shorts in the market would be those who are very good at long, buying innovation, because innovation has meat around the bone. It's not just when something's new and unproven, it's innovation. Innovation is iterative engineering around problems with an obsession to lower costs and increase customer value. That's what innovation is, in our view. And I think if you focus on that as an investor, you can buy it and you can short it, because you'll find a lot of imposters. You'll find a lot of pseudo-entrepreneurs, pseudo-innovators who pretend to be innovators. And there's a lot of them. We distinguish three of them in the essay. The fraudsters like FTX, the guys who sort of, let's say, are borderline fraudsters. We would call, let's say, people like WeWork and even Uber to some extent to that. I'll explain why. And then there's just a lot of mediocre entrepreneurs. And when I say mediocre, I mean there may be good technology people. I would say even companies like Dropbox, Slack, they all fall into this category. They're not that bad in a sense, like certainly not frosters or anything, but they just weren't able to build real stacks, real innovation stacks to really generate wealth. They solved a certain technology problem, and now they're stuck in a very competitive market, and they can't generate wealth. So all of these types of stocks are good shorts, because of course they're only good shorts if they're also valued as real true disruptors. If they're valued as such, like Dropbox right now, then it's not a good short anymore. Dropbox is just valued as a low growth tech company, and that's fine. Like companies like there's plenty of companies like that. I don't know, Groupon and so on and so forth. They're just tech companies. They have a little bit, just because, by the way, just because you hire software engineers that know the difference between C and C++ doesn't make you an innovator. It doesn't make you a disruptor. You're just a tech company. And there's a lot of tech companies that are in very competitive markets, stuck in very difficult, margin situations and all those things. And they're fine. You can buy them as an investor. You can make a few % return per annum and all that stuff. But you don't want to pay the 12 to 20 times sales for these types of companies, because they're not worth it. Those are the shorts that you want to attack. So again, we believe that there is a place for genuine shorts, and the way you do that, the way you go after that, is actually the same way you go after buying innovation. It is, again, iterative engineering with obsession to lower cost and increase customer value. That's what innovation is. And as an investor, you can isolate, you can identify the companies that do this kind of stuff. You don't want to short those. But companies like Amazon and Tesla are just sort of the big examples. There's lots of others. But Amazon, if you go back to the shareholder letters of Jeff Bezos way back in the mid-90s and then going into the 2000s, he doesn't speak about innovation. He just talks about customer value. He talks about lowering the cost of increasing customer value. That's true innovation. Now, of course, there's a lot of other factors attached to it. You have to have a good innovation stack. You have to solve engineering problems, and you have technology risk, and you have market risk, and you have macro risk. But overall, if you're exposed to a company that is obsessively trying to lower cost, increase customer value, and iterates around engineering, you're probably better off not shorting that kind of company, because the risk is too high. If they succeed, they can create trillions of dollars, and that's just not worth, you'd be out of business. If you're a genuine short, which again is having skin in the game. People like Jim Chanos, let's take him as an example. He claims to be long the market and then short companies. I believe he's not short companies, he buys puts on companies. So he plays some sort of, not really a dispersion strategy, but what he's really doing is he's buying lottery tickets on innovation failing. That's fine, you can do that. You can have a worldview like that everything fails most of the time, and you buy these lottery tickets. I would say that overall, that's a strategy that at best will not return you any money, because that's priced in the options market. I've been an options trader myself for many years, and I can tell you that, options price in the most obvious stuff. So if you want to if you want to participate in failing innovation through options, you're not going to win. You're going to win the other way around if you participate in the upside of innovation, because that's the less likely scenario. Innovation most of the time fails, yes, but playing it with puts is just not, it's an obvious thing. It's stating the obvious, and you're not going to make money. That's my point. However, every now and then one of them breaks through and creates massive, massive value. That's where you make the real money. So we have a few interesting thoughts here that, by the way, are inspired by Cormac McCarthy's latest book, The Passenger, which is amazing. I would say probably, if not, certainly one of the best books I've read in many, many years. I haven't finished yet, but it's amazing. There's a line there, and I'm paraphrasing. I don't know the exact details, but one of the paraphrases that I used is, there is an alternative to hype. It's called engineering. So this is again, it's paraphrased from a sentence in the book. I don't remember exactly, but let's talk about this now. What do we mean with that? Look, a lot of innovation, everything, let's say Elon Musk, our largest position is Tesla. A lot of the stuff that he does is hype. Yes, it is hype, but there is an alternative to hype, or excuse me, the best remedy to hype actually is engineering. That's the exact phrase. So the best remedy to hype is engineering. Yeah, if you want to go to Mars, if you want to electrify transport, if you want to, change the energy equation and bring in more sustainable energy into the world, if you want to do all of this, you're going to be prone to hype. But the best remedy is actually engineering, iterative engineering, solving problems, creating new problems, solving them. This is what it is. And if you listen to people that work with Musk, if you listen to Musk himself, if you listen to people at SpaceX, it's all about iteration. We've been saying that so many times in this podcast. It just come back. And again, if you want to be short something, just look for that. Just look for, well, how much iteration do you guys actually do? And you'll find out that, companies like Uber, and we mention Uber in the essay as a company that is a short from an innovation perspective, because they don't do that. They don't obsess with engineering solutions to lower costs and increase customer value. In fact, their strategy was the other way around. They lowered the cost by subsidizing customer, hoping to get rid of competition, and then raise prices. That's predatory capitalism. The same with DoorDash. A lot of these types of companies that happen to be funded by SoftBank, which again, they have that kind of strategy, and that's fine. Moshe Son believes in that kind of business strategy. Get in there, put a lot of money, get rid of all the customers, and then raise prices. That's predatory capitalism. That's not innovation. We would suggest to be short something like that. So that's an okay short. Again, what you don't want to short is companies that are obsessively iterating around engineering practices to lower costs and increase customer value. And most companies don't do that. So there is, like we said in the title, a genuine place for short sellers in the market. They'd be very helpful. They provide liquidity. They put our optimism in check and all of that stuff. But it's a tough one because, again, it's very risky. So the best way to do this, to be a genuine short, to have real risk skin in the game, not just to throw, puts at the wall hoping that something sticks, but actually put some real money at risk. You can do it through options, but put some real money at risk. Okay, don't just, spread it over many positions. That's fine, you can do that, but then don't call yourself a short seller. That's my point. Don't go on TV or whatever and say, I'm short this stock. You're not short. You have a few, at best you lose 1 or 2% of your portfolio. That's not being short nothing, particularly in this day and age with all this, volatility. A few percent here and there is nothing. So don't claim to be short. You can have a worldview that, status quo is, if your investment thesis is the status quo, which again is one of the lines in our essay, and we're actually saying, the status quo is not an investment thesis. So if that's your investment thesis, you're not an investor. This applies, let's say, to Bloomberg, a critique of Bloomberg, which, by the way, I've said that several times on this podcast. We read their newsletters. It's an interesting, inspiring, thought-provoking newsletter. We just feel like that their arguments are watered down because they suffer confirmation bias, and their thesis is basically status quo. Everything else doesn't work, and that's just not a good start of any kind of conversation when it comes to to technology and so on and so forth. So if your thesis is the status quo, then you're not an investor. You have a worldview. That's fine. You can have that worldview, but you're not an investor. To conclude, we're discussing our new essay. We need genuine short sellers, not imposters. What do we mean with imposters? It's people that pretend to be short sellers but are not. They really are just either gamblers or actually just merchant of doubt. They don't even have a position. We believe that a lot of these companies, let's say also David Einhorn is another one. Supposedly he runs a hedge fund. Supposedly he's long short. If you look at these positions, I don't even know if whatever is public there, if it's real and what the real funds are. The problem with the hedge fund industry is value score. They choose to publish whatever they want to publish. There's not a lot of regulation about what they need to publish and how and so on and so forth, what the returns are, what the positions are. But I would just say again, if you really are short a stock like Tesla, by now you're out of business. So I don't really understand how you can be short something like that. So anyway, my point here is being that these are merchants of doubt. They make a living, marketing themselves. They go on these conferences and TVs and all that to for clickbait, for viewership, and then maybe they can raise money and collect fees. That's fine. That's a business model. But we believe that the markets will be much better off with real, genuine short sellers. And our argument in this essay is that there is a way for genuine short sellers in innovation. This is the key argument. And genuine short sellers in innovation, they have to do the same work like the long investors. They have to analyze companies as innovators and identify those that do the kind of work that is necessary to be an innovator, which is to iteratively find engineering solutions and obsessively lower costs and increase customer value. For companies that do that, there is a place to belong. And for those who claim to be innovators but don't do that, those are the ones you want to short. So there's a genuine place for short sellers to scrutinize the market and find the entrepreneurs, founders, management teams that pretend to be innovators but don't actually do the process that is necessary to be an innovator. There are lots of technology companies out there. Companies, every company is a software company in a sense. Everybody hires programmers and IT people and all that kind of stuff. There is such a thing as a technology company, but they're not necessarily innovators. And when they trade at 12 to 20 times sales, that means when the market assigns them a value that true innovators deserve, but then you as an investor, you realize that they're not true innovators, that's when you short them. There was a time when it was good to be short Dropbox or Groupon. There was a time when it was good to be short Uber. Actually, it's still a good time. And the reason it's a good time to short a company like Uber is because they trade at the valuation of an innovator and they're not a true innovator. This is the key. So what a genuine short seller in innovation is supposed to do is isolate the companies that trade like innovators and then scrutinize them according to a principle stack that defines if you're a true innovator or not. And if there's a discrepancy, then you short them. And if not, then you don't. So if companies like Tesla really are actually iterating around engineering practices, obsessively lower the total cost of ownership and increase customer value, if they keep doing that and iteratively drive value, you're not in a good position to be short. It's just the risk reward doesn't work. That's the key. Okay, I'm not saying it's wrong. They can still be wrong. They can execute wrongly. Macro can do something to them, political interference, but it's just the risk reward doesn't work. However, if you have a company that trades 12 to 20 times sales and they aren't true innovators, as defined, as we just said, iteratively finding engineering solutions, solving problems, creating new problems, solving problems, driving down costs and increasing customer value. Companies that do that, they're not true, companies that do that, they are true innovators. Companies that don't do that, but claim to be innovators and trade like innovators, those are the shorts you want to attack. I'm sorry for the convolution, but this long short, it's kind of like you're looking at something from the other side and then you do using double negatives. So again, I just want to be very clear. There is one type of company that we call a true innovator. It's a company that iteratively finds engineering solutions, obsessively drives down costs and increases customer value. That's the kind of company that if they trade at a high valuation, you don't want to short because the risk is too high to be short. However, if there are companies that are not iteratively finding engineering solutions, that are not obsessively driving down costs and not obsessively increasing customer value, but for some reason they have an attachment of a valuation that is eluding that somehow they are an innovator, those are the kinds of companies you want to short. This is the key argument of this essay. Thank you.